Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
All right. Hey, folks. Hope you're enjoying your summer and welcome to July. Can you believe it's the end of July? July's In Conversation with, where we had heard what we all expected. No change in the Bank of Canada rate. I think Sherry, it's getting kind of boring. We're predicting these interest rates, and of course you predicted it again. But maybe it shouldn't be a surprise as inflation becomes sticky. With tariffs still sort of looming, lots of uncertainty, and but you do think, and I read your report, you do think there's going to be at least one drop this year, possibly two, but at least one. But
yeah, I mean, one more, maybe two more rate cuts. The economy is actually holding up reasonably well, considering.
Yeah, it's amazing.
Yeah,
it really is. Well, folks, as you know, we're going to go through the entire presentation, but please send your questions in the chat. We'll get to them at the end of Sherry's presentation. We're looking forward to that, Sherry. I know you have lots to talk about. We have the situation in the south of the border with Mr. Trump, the tariffs looming, inflation looming, rates not really changing, lots going on, the housing market. Can't wait to hear it all. Over to you.
Thank you, Eddy. Hello, everyone. Yes, we live in interesting times, and every day you never know what will be in front of us. Clearly, the Bank of Canada is cautiously assessing the situation. Interestingly, in their monetary policy report today, the bank did not provide a standard forecast for the economy, but instead showed us what would be the baseline for their forecast, and then a situation where the tariffs are worse than expected or lower than expected. It is a period of enormous stress on the global economy and financial markets. And unfortunately, it's not over yet. And these arbitrary deadlines, like Friday's deadline, are just that. They're arbitrary. And clearly, Canada's in a unique position. And not a uniquely bad position, because the United States has done a deal with Europe and done a deal with Japan. And for example, the tariff on the European automobiles and Japanese automobiles will be 15%, whereas right now in Canada, cars produced in Canada and exported to the US, if they're not under the free trade agreement, would have a 25% tariff rate. So explain to me why Canada is singled out as a particular problem in this regard. I don't really understand it. So let's begin with what we're exactly talking about, which of course is Mr. Trump south of the border, tariff man he certainly is. This is very interesting. It shows you what the effective tariff rate is. So looking at the effective tariff rate, which is just a weighted average of tariffs to all the many tariffs to each of the different countries. So on average, the tariff rate is 17.3%, which, as you can see from this chart, is incredibly high. And in fact, it's the only time it's been surpassed is back in the 1930s when the Smoot-Hawley Tariff Act was introduced in the United States. And by the way, that tariff has largely been fingered as the one policy move that extended and accelerated the Great Depression. So clearly, we aren't operating in business as usual territory right now. You can see from this chart, which shows you economies ranked by their exposure of exports to the US, that Mexico, Canada, and Vietnam are the most vulnerable. And as I've said, Canada is in a unique position in this regard, and uniquely important for the United States as well. Canada is the US's second largest trading partner and the #1 market for US goods and services. So Canada has the second lowest trade deficit in goods and services with the US, as you can see from this, by far much lower than China or Mexico. And excluding Canadian energy exports, the US has a trade surplus with Canada. And the US needs the Canadian oil exports. So why pick on us? In addition, Canada is the largest exporter of steel and aluminum to the United States. We have a large competitive advantage in steel and aluminum production because we have the low costs in our electricity thanks to hydroelectric power. So that's why so much of what is produced in steel and aluminum is benefiting from the tremendous advantage we have. The US needs this aluminum and steel, and thus far the data are showing that the biggest impact of the tariffs has been in the manufacturing sector and particularly in the steel industry. Early days yet, but you see that Canada is a much more open economy than the United States. Exports of goods and services relative to GDP is only 11% in the United States, which is considered a closed economy. In Canada, exports of goods and services are a third of our GDP. And therefore, we are an open economy, and we are one of the major trading countries in the world. So Canada is dependent on the US. The US has been the export destination for nearly 80% of Canadian goods traded. That compares to other countries trade with the US. No other country accounts for greater than 5% of Canadian export volume. So it's a very big deal for us. And the US now, with the latest data, accounts for only 70% of Canadian exports, the lowest level we've seen in decades. That's not such a good thing, though, because clearly our exports have diminished in the more recent period. The US, though, needs Canada. Canada is the largest export destination for US goods, followed by Mexico and China. full onshoring of all non-US auto production would require a 75% boost in US production and $50 billion in new factories. And this would take years to put in place and substantially reduce the profitability of US automobile companies, because the Canadian auto manufacturers are the Detroit Big Three. So clearly, putting tariffs on things like Canadian automobiles is the US shooting itself in the foot. Now, yes, the automobile companies could close down their facilities in Canada and produce in the United States only, but that would dramatically increase their costs, reduce their profitability, increase auto prices, and some of that has already been put in place. Here you can see that the Canadian auto sector is very vulnerable. That this pink line is Canada's exports to the United States, exports of autos. And that has trended downward in the more recent period, where in place we've seen Mexico increasing. US exports to Canada and US exports to Mexico are, of course, far, far less than Mexico and Canada's exports to the US. But again, this was the choice of American businesses that benefit from either the supply of Canadian materials, goods, and services, as well as benefit from producing autos and other products in Canada, where, thanks to our healthcare system, the medical expenses for automobile workers and pensioners was so much lower that the Auto Pact was signed literally decades ago to the benefit of all countries involved. Here's another thing that hasn't gotten much attention. Right now, China is shifting its oil purchases from the US to Canada. So it's very early days yet, but you can see that Canadian exports to China for oil are trending upward, whereas the U.S. Exports of oil to China is trending downward. I'm telling you, I pondered what I wanted to call this section of my presentation. Should I call it Canadian resilience, or are we in for a soft landing, or will it be a harder landing? And of course, no one knows. I do believe, though, that the likeliest prospect is a soft landing, but that doesn't mean it's painless. And clearly, those sectors that are the most trade dependent with the United States will be hardest hit. And we've already seen that. Now, the Canadian economy has proven to be remarkably resilient. This chart shows you an index put together by Citibank that looks at the Canadian economic indicators as they come in and plots whether they're stronger or weaker than expected. And what we've seen in the past couple of years is it's less disappointment and more upside surprises. And that has continued even through the most recent period, which is very good news. So I'm forecasting a slowdown, certainly, that once we see first quarter GDP growth, which will be next week, I think that'll be around 2.2%. We'll see modest declines in growth in the third quarter of this year. And it's kind of 50-50 whether it's a small positive or a small negative for GDP growth in the final quarter of this year. I could be a mini recession, but it would certainly be mini and far, far less damaging than what was predicted even 6 months ago. One thing we have seen is even though the central banks in the US and Canada have not cut interest rates, long-term interest rates are rising. So the overnight rate has been held steady. The short-term bill rates have edged up only slightly, but long-term interest rates are increasing considerably. And as a direct result of that, we've seen fixed mortgage rates move up. Now, another remarkable development has been the strengthening of the Canadian dollar, which is really just the flip side of the weakening of the US dollar. Now, since Trump's inauguration 6 months ago, let's say, the United States has put through Congress the one big beautiful bill that's going to increase the federal budget deficit by trillions of dollars. Debt will increase by an estimated $4 trillion, and US debt to GDP from a federal government perspective is already at very high levels. The US Treasury market was downgraded by Standard & Poor's, and what you see here is there has been some selling of US government bonds, longer term bonds, as a result of it. In other words, foreign countries are wondering about the safety and soundness of the US financial system, given all that's going on. And so some have been selling US assets in US dollars, which leads to an upward movement in long-term interest rates. The Treasury bond price falls, meaning interest rates increase for that maturity. And that's exactly what we've seen. And certainly one would never have predicted in this environment that the Canadian dollar would have strengthened. Now look at the federal debt to GDP. These numbers in the United States are truly exploding. In fact, when I first looked at these data showing the Canadian gross debt to GDP versus the government in the United States debt to GDP, I thought this can't be right, but it is right. And no one's arguing that Canadian fiscal policy has been tight or that our budget deficits have been small. This shows you that with the passage of the big beautiful bill, that those debt numbers are getting even higher. So in other words, debt to GDP in the United States could be roughly 125% of GDP. Now, that's a record, but people have asked me, well, what's the limit here? And lots of work has been done on looking at that, and judging from the experience of Japan, where the debt to GDP ratio was 150% a while ago, the US has much more leeway because it is the currency of trade, but 175 to 200% GDP is unsustainable. And we, depending on what happens to the economy, we may be headed there. Canada, as much as we rue our deficits, Canada has the smallest deficit to GDP ratio in the G7, which is important because it gives us some degrees of freedom in terms of easing fiscal policy in the coming budget in the fall, as a direct response to those hardest hit by the tariffs. This just shows you that US customs duties have just skyrocketed. This could help to reduce the federal budget deficit depending on how it's used. Trump has even speculated that maybe some of this money should be sent back to taxpayers. Another potential tax cut in the United States. Who knows? But clearly, this is a drain on private economic growth. As more money piles into the US coffers, this is less money for businesses and consumers everywhere in the world. Now, this has had a dramatic impact on housing markets, and not just in Canada, of course, but in the United States and elsewhere in the world. Fixed mortgage rates are rising as lenders have retreated from what was very aggressive pricing. Direct result of that increase in the Treasury bond yields and therefore Government of Canada bond yields. The big six Canadian banks are no longer marketing sub 4% mortgage rates, as you well know, and the share of prime broker customers who are choosing to take floating rates has fallen. So it's fallen to just over 28% from 29.1% in April. Mortgage originations have bottomed. So we see this is total bank purchases and refis and renewals in the last 12 months. So these numbers may be largely as a result of renewals and refis as opposed to purchases. But this has kept the mortgage origination numbers much stronger than we would see otherwise. And this shows you the actual variable rate market share. And it has trended downward here in the most recent past. And you see the reason that now that the 5-year fixed rate mortgage rate was increased. And we see now that really it's the 5-year fix that would be based on simulations of this forecast for interest rates that makes more sense now than floating rates, given the uncertainty as well as the potential for higher inflation. Canada, as we know, is far more interest sensitive than the United States because of our maximum 5-year mortgage renewals as opposed to the 30-year loans that it get in the United States. So big changes in interest rates do matter very substantially. We've seen as well that Canada's unemployment rate ticked down in June. Our labor markets are holding up relatively well right now, but again, these are early days. We saw an uptick in net job creation of 83,000 for the latest data for the month of June, and we saw the unemployment rate move down a tick from 7 to 6.9%. This shows you the Canadian unemployment data compared to the US. And you see the US unemployment rate is far below that of Canada, part and parcel of our greater interest sensitivity and the sensitivity of our economy to export and import changes relative to the US. And a recent survey showed that more people expect to lose their jobs. Well, that's not a big surprise given what's happened, but clearly this is something that might bode well for further interest rate cuts by the Bank of Canada. Wage inflation has ticked down sharply. Now, Canadian inflation has risen to 1.9%. Let's just look at that. April, May, we saw the year-over-year inflation measured by the CPI at 1.7%, ticked up to 1.9%. Still, this is within the Bank of Canada's 2% target band. We also, however, look at some of the core measures of inflation, and there we see that core inflation, excluding food, energy, taxes, and a whole host of other things, the core inflation numbers are running at 3.1% year over year, which is too high. as far as the Bank of Canada is concerned. And hopefully that will begin to edge downward, but again, uncertainty. It's a really divergent inflation experience in the two countries. As you see here, Canadian headline inflation is below the US, but Canadian core inflation is above the US. Just an interesting tidbit there. So the trend in terms of the 3-month moving average for these data are on the upside for core inflation measures, which has kept the Bank of Canada on the sidelines for 3 consecutive meetings. And this afternoon, it's already happened. I haven't heard formally, but my guess is the Fed did not cut interest rates despite the unprecedented pressure coming from the White House. Another thing that's happened in Canada's inflation story is that the breadth of inflation, the share of inflation that's growing at over 3% annualized rates, is now flattening out at roughly 40%. But the good news is that we've seen shelter inflation come down significantly as rents have reduced. Inflation expectations have ticked up, but they're still quite manageable given all that's going on. But you see that as the condo starts have declined dramatically, despite that, the rental condos, the starts on rental purpose-built properties has increased sharply. So we also have seen a downward trend in rents. So that gets us then to today's action or inaction by the Bank of Canada, holding rates steady as all the tariff turmoil continues. So this is, as I said, the 3rd consecutive meeting where they've held rates steady. They meet again on September 17th, so that's a bit of a break. The 5-year yield is at 3.03 roughly percent. Again, it has trended upward in the last few months. It's certainly since the inauguration was about here, and certainly since the tariff news has broken, we've seen upward trend in longer term interest rates. This is the decision dates. We've got time now for the Bank of Canada to assess the economy and the inflation. I think that we'll get at least one more cut in the overnight rate sometime in the 4th quarter of this year, but it could be 2 cuts. It just depends, of course, on the incoming economic data. In today's press release, the Bank of Canada did say right out that directly, if the economy slows and inflation is muted, there could well be reason for the bank to cut interest rates again. They actually, I'm paraphrasing, but they actually said that. So this was considered a dovish move by the Bank of Canada. And this just shows you, the forecasts for the big Canadian banks in terms of RBC and Scotiabank, if they haven't changed their tune, are saying no more rate cuts are coming. And the others are more in the camp of 1 or 2 rate cuts. BMO thinks 2, everybody else is suggesting 1, and of course, no one knows. The Canadian housing market, I'm optimistic. Now, I know it hasn't been a beautiful story during the spring season. Normally, this shows you the share of Canadian home sales in each month of the year. And normally, the spring season in here is the strongest time of year, but of course, not so this year. And that has been reflected in housing activity across the country, with a few exceptions. June home sales picked up nationally, but they're still below the 10-year average for monthly sales. And this shows you, again, for the second quarter, the net sales activity is certainly subpar, and especially compared to the early COVID days when interest rates were at 25 basis points. New listings actually fell 2.9% month over month in June. And market balance shows you that most markets are balanced. Arguably, Toronto and Vancouver are buyers markets, particularly for condos, but much more strength in places like, in fact, considerable strength in places like Calgary and parts of Quebec. So we've got, this shows you Toronto and Vancouver remaining in buyer's market territory, where the other provinces not so much, or other cities. And more housing starts in Alberta this last 12 months than in Ontario. I mean, that is unprecedented. Alberta's population is about a third the size of Ontario's, and their labor force is about a third the size of Ontario's. So this is, again, another one of those never before, once ever developments. And of course, we see this is the home price index, the national home price index, but there's still prices falling nationally. Average 5-year home price gain is still 36.7%. So keep that in mind. You know, this big increase, it was never sustainable, and interest rates were cut far, far too low and left there for too long. We see that with hindsight. So it's not surprising that we see a correction subsequently. Delinquency rates are rising. This chart showing the percent of mortgage originations in arrears and the number of mortgages in arrears. It's trended upward, but it's still very manageable and far, far less than what we're seeing in the United States. Now, the population story, a big shift. It's a complete 180 from what we saw a year ago. The immigration targets have been slashed, and there has been really substantial follow through on the promises to cut the number of foreign students and temporary workers. They've also taken down the number of permanent immigrants. So big change, and clearly that has ramifications for the economy. When population growth plunges, we saw it just in the first quarter, Stats Canada said population growth was 0. Now, aside from the third quarter of 2020, when COVID border restrictions reigned, this is the weakest population growth in Canada in 80 years. So big story here, that even if there were no tariffs and nothing else had happened in the world, to see population growth going from very high levels to virtually nil, big impact on the economy, a big impact on the housing markets. We've seen a net outflow of non-permanent workers, and there's likely to be continuation of that. We've also seen announcements by many of the smaller Canadian universities and colleges in trouble financially because foreign students have declined and they paid full freight for tuition. And the population numbers are slated to fall even further as we move into 2026 and 2027. So slower population growth reduces economic growth and inflation. which is consistent with lower interest rates. So again, this is a temporary period of great uncertainty and instability. But the economy, the labor markets, and the Canadian dollar are holding up incredibly well. Thanks, Eddy. I'm happy to open this up for questions and comments.
Thank you. Thank you, Sherry. I wrote 2 pages of notes here as you're going. And one of the things that was glaring to me is the May new homes sales report. I don't know if you're familiar with it, but I'll just give you an idea. On the average month in the spring, there's 2,750 new home sales on average. April, May, June, there was 310.
Whoa! Did you say 2,700 went to 310?
Historically, typically, the average new home sales a month in the GTA, 7 million people, is 2,750. In May, it was 310 homes. So obviously, Canadians are not in the buying mood, and you see that buyer's market. But I'm with you. You said that you're optimistic. So am I. What a great time to buy. If you're a first-time home buyer, if you're that move-up buyer, I mean, everything's relative. You sell, you buy, but you get more house, right? On a percentage basis. So if you're losing 10% on your home on both ends and you're move-up buyer, then there is that opportunity to get more house for less. But I agree with you. I'm very optimistic. And this is not going to last forever. I mean, obviously, as things improve, you saw those immigration numbers. But as things improve, rates come down, prices go up. I also want to talk about renewals for 1 second. And we talked a little bit about it before we started this broadcast. Our biggest renewal is coming up. It's going to be in the next 12 months. And that renewal is a couple of things. One is the refinance piece of that. So if you are looking to buy that investment property, you're looking maybe to move up or looking to maybe invest or take equity at your home, great time to do it. Rates are decent. I mean, if you look historically, and you've had that up on your charts before, rates at 4% aren't terrible.
No.
It's just, unfortunately, we got used to that sort of sub 3 and even sometimes 2 back in 2022, but 4% isn't terrible. So there's that opportunity to refinance. And of course, calling one of our DLC mortgage brokers, you can reach us at www.dominionlending.ca, and we can connect with you and talk about your situation, talk about if a variable rate is right for you, if a fixed rate is right for you, look at your situation and customize a mortgage for you. The other thing that I thought was very interesting is that 5-year average, you saw a 36.7% gain.
Right.
So if you bought today in the next 5 years, listen, is it going to be that high? Don't know. But what is clear is real estate is still a great investment. And you have to catch these buying times. So I think there's great opportunity out there. And I hope that people are going to take advantage. And then one last thing that was glaring to me is when you showed that chart of Ontario and Alberta, new homes, and they converged. And now historically for the first time, and you mentioned labor force, the size of the economies, et cetera. Wow. That was that was incredible. And again, if you have any questions, shoot them over. That's what are your thoughts? I think we're in unprecedented times, and I think it's all because of that leader in the South. I don't think this is ever going to happen without that kind of leadership and what Trump is doing with the uncertainty in the market. Obviously, that's causing people to stay on the sidelines. I've never seen, stale, and I'm in the GTA, stale listings and people just waiting to see some certainty. Would you agree with that?
Yeah, absolutely. And prices are coming down. I mean, I have a condo for sale, and I've cut the price twice now. it is a buyer's market, and I think there's real opportunities out there, and I'm not sure we'll see these opportunities anytime again soon. So and locking in 5-year fixed at 4%-ish is not bad at all. I mean, we aren't ever going back to sub 2% mortgage rates. That's a bold statement, and ever is a long time, but I mean, certainly not anytime in the foreseeable future. So anyone who's waiting for that is just dead wrong.
And seeing the oil exports to China and seeing that blip of that increase. So obviously Canada is looking for alternatives for trade. I think that's important, right? Our European friends, obviously our South American.
We are, but there is no alternative to the U.S. economy in the sense of just the sheer size of it, and the wealth and the demand, the needs and the proximity to Canada puts us in a unique position, and in a very favorable position, which we'll go back to. But I mean, clearly the world has changed, and putting all our eggs in the U.S. basket makes no sense.
Yeah, that's fair enough. Okay, let's get to the question. The first one's from Asim. We sort of touched on it. In light of all that is happening, are today's rates reasonable from a historical perspective? And we both agreed, yes, we think they're very reasonable. It's just conditioning, right? We are a little bit conditioned on those lower rates. They're not that far back, and we're still thinking, it'll be in the 3s or maybe in the 2s one day. Hard to say, but I would say, and if you agree, Sherry, that yes, they're very reasonable.
Yeah. Right.
Okay, Chris Murphy asks, Trump's gambling so far is paying off. What would derail his push to rebalance the U.S. economy?
Now, if nothing, in my view, is predictable about this. Firstly, would it make any difference? Like, is Trump really the sole essential person in this administration? Even if Trump were hit by lots tomorrow, which of course isn't going to happen, we'd still deal with Vance. We'd still have Project 2025, which is the obliteration of the US government and the introduction of all these tariffs, and this whole policy plan wouldn't change. And so, Trump seems to be Teflon, but let's face it, the guy is nearly 80 years old. He can't run again. He's not in the greatest health. This is symptomatic. This MAGA thing is symptomatic of far greater forces than just one individual. And who knows? I mean, if there are what would surprise the world sufficiently to derail the current policy? In a sense, it is derailing in that he makes the major announcement and then he steps back from it, or he extends the deadlines, which he keeps doing. And therefore, there are no deadlines. I mean, August 1st will come and go, and nothing changes. And I do think that it's possible to negotiate, although at this stage, he wants to maintain tariffs indefinitely because he needs a new source of funding for the what he wants out of the U.S. economy. And that's, what he's doing is beggar thy neighbor is exactly this mercantilist policy, is get everybody else to pay the bills. And in some cases, it may be a reasonable suggestion, but this is what we're dealing with. And prices, and there's no question that prices at the Walmarts and Amazons of the world have gone up. So I think the inflation data have held up pretty well. Remember that a tariff is like a tax. It's not inflationary. It's a one-shot increase in price. That's not inflation. Right. Inflation is rising prices.
Right.
So you get an initial bump in inflation because the price level goes up all of a sudden. But after that, if it leads to slower spending by consumers and businesses because they can't afford as much, then those prices could come down again.
Well, and you said one of the, checks and balances is the stock market. So if people are spending less, that means businesses are going to be making less and showing less profits, which means people are going to sell those stocks, which means the stock market's going to go down. So that can be derailment.
What's happening with the stock market is it is driven by a relatively small number of companies that are not tied directly to the vagaries of US GDP.
That makes sense.
I mean, companies like Apple and Nvidia and Google and Microsoft, etc. So, and the stock market has done incredibly well, and the Canadian stock market has done incredibly well. I mean, we're going to keep hitting record highs for the TSX. So that's what I mean. That there's underlying fundamentals that are still very positive. There's a lot of money on the sidelines waiting for a home, and it's going into the stock market. It's not going into bonds much, and it's clearly possible that we'll see, things turn out much better than what is likely, at the moment. That's why the Bank of Canada used different scenarios for the forecast. And one was that it turns out the tariffs are lower than what they're currently stacked at, 35% for Canada for non-free trade items. That's a lot, not to mention 50% on aluminum and steel. And he says it could be 50% on copper. Copper's in everything. I mean, all of this is, again, very disruptive. But it's an opportunity and not likely one to be repeated anytime soon.
Yeah, I agree. Let's go to Paul Masur. Hey, Paul. Hope you're doing well. Lots of uncertainty in Ontario. Will their manufacturing sector ever recover?
Yeah. Well, I mean, that's pretty dire sounding. A lot of companies will resource and will work very closely, very hard to expand their customer base, and with some success. But there's no replacement for the US, and no country where we have, cheaper transportation costs. Not to mention, I was recently in the US visiting family and drove across the border. There were no trucks, like no trucks on the Peace Bridge. Can you believe it? It's like scary.
I was talking to
so clearly Ontario is impacted.
Sorry, Hitcher. I was just talking to a developer. I was at a golf tournament, and he builds, under a few hundred homes a year, but nonetheless, he's been steady over the years and decades building that many, and they haven't sold a new home in 2 years, haven't really built, or only have inventory that they're selling, and they once had 67 staff, they're down to 7. But it's also the waterfall effect of that. So those, coffee trucks that go to the sites, and obviously the trades, and then, the suppliers, and there's all those other businesses that are going to be affected by, those lack of builds. So it's the economy is, and I think our GDP is pretty big when it comes to new construction and new homes.
Sure.
We're reliant on that business, and if it keeps wavering, then it's going to cause a GDP issue for sure.
And housing has got to be at least 20% of the economy,
20%
and much more in terms of the spin-offs, like the appliances and the paint and the carpeting and everything else that goes with moving. So Right. This has a very big impact. That's why monetary policy works the way it does, because interest rate movements affect the most interest sensitive sectors, housing being number one. And therefore, monetary policy is effective. If you raise rates, the economy slows. If you lower rates, the economy accelerates. That's the housing side of this is collateral damage, and certainly it's nothing to do with the tariff story, but it's not surprising. And given how much, with the activity that we saw just in 2020 to 2021, you wouldn't expect, you'd expect some kind of correction, but this obviously is bigger than anything we've seen historically, except back in the early 90s in Ontario, there was major correction. And but that was again following a period of like straight up house price inflation. So we've seen this before. It didn't lead to a collapse or a crash or anything like that. And 10 years later, the markets were booming and all is well. So,
Jason Nugent just commented that housing is a big part of the U.S. GDP as well. And will that come back to bite them? I would imagine yes.
Absolutely, and it is, and it's mortgage rates are high in the U.S., 7-8%. And in addition, people are, there isn't much activity going on, nowhere near the building before. In many regions, there's literally dead. All of Florida is dead. The markets that were booming have become very, very weak.
So interesting. Let's go to one more question. Asim asked, Dr. Cooper, if you were advising your kids today, your little teenage kids, that's what you have today, would you advise them to go variable or fixed?
Well, right now, I think interest rates ultimately are going to trend upward. They've already come down quite a bit. I'm risk averse, so I don't see what harm there is in locking in for a few years. But I don't say that that's right for everyone. Some people like to, take it. See, what's happened is since the 1980s, interest rates have trended downward. So that's a very long period of time, right? 40 years, more than 40 years. 45 years of this trending downward interest rates meant that variable always be fixed. But that's over. We're not going to see interest rates like trend downward over the next 10 years. So, right? You can't say that variable always wins.
I'm smiling because I hear my father's voice telling me about his 14% mortgage and nothing to complain about. So that's why I'm smiling. But yeah, that's a very good point. Rates are still historically low if you compare and you go back 20, 30, 40 years. But housing is expensive, and it definitely is much more on a income to purchase ratio. But at the same time, affordability comes with what you can afford, and having that advisor and ensuring that if it's a variable or fixed, or if you should be buying that home or not, you're best seeing a mortgage broker. And again, dominionlending.ca is probably your best bet. So please visit us, connect with one of our mortgage professionals, and we can help you through the process. Okay, I'm going to go one more. I said one more, but Mortgages by Mark just asked a question. What are your thoughts about cryptocurrency and how the U.S. government is planning a Bitcoin reserve? Is this safety measure investment to offset the weakened dollar?
No, this is investment to enrich the Trump family. Seriously, honestly, this has nothing to do with rational financial regulation. But that don't get me going on all that. And crypto, I mean, like anybody, go for it if you've got the stomach for it. I don't, but more power to you. It's like it's gambling. It's gambling, but life's a gamble, right?
Yeah, absolutely. Well, on that note, Sherry, thanks so much. Always appreciate your insights. Thanks everyone for tuning in. Our next meeting is September 17th. So August is summertime. I hope you guys are going to enjoy that time off with family. The weather has been just unbelievable. Sherry and I were just talking about, she thinks it's too hot. I think it's not hot enough. And remind you that in 6 months when it's minus 30, you're going to go, you know what? I don't mind this hot weather. But thanks, everyone. Really appreciate you. Until next time, take care. Bye-bye.